Seadrill delivered a massive beat for Q2 2026. The Q2 EPS came in at 47 cents, completely obliterating.
Yeah, obliterating the consensus estimates of 28 to 29 cents.
Right. I mean, that is a 169% year-over-year improvement from a 68-cent loss.
Yeah.
And total operating revenue hit $449 million, easily clearing the $385 to $388.5 million expectation.
Management also raised full year 2026 guidance, by the way, for the second time this year.
Oh, wow. Second time.
Yeah. Revenue is now projected at $1.50 to $1.55 billion, and that's excluding $50 million of reimbursables, and they bumped up adjusted EBITDA to a range of $420 to $450 million.
Got it. And CapEx?
CapEx is being maintained at $200 to $240 million.
So no surprise, the stock gapped up 6.4% in pre-market trading to $46 flat following the print. It eventually settled in the 46.7 to 47.98 range.
Which is a solid game.
Yeah, definitely a solid gain, though the stock is still well off its 52-week high of 55.47. So today we are doing a deep dive into a huge stack of financial reports, analyst notes, and management transcripts for Seadrill.
Right, because if you're looking at your portfolio right now, you need to understand what is actually happening under the hood here.
Exactly. Our mission is to figure out if this massive beat is a genuine operational turnaround or, just an optical illusion hiding a massive cash burn.
Because compared to the prior quarter's 11-cent loss, this earnings beat looks like a massive grand slam.
It really does.
Yeah.
But I have to ask, how much of this was genuinely superior operations versus just an easy comparative hurdle from a weak Q1?
Well, I mean, the underlying metrics point to genuine operational strength this quarter. It's not just favorable year-over-year or sequential comps.
Okay, so where do we see that in the numbers?
To see how they actually achieve this, you have to look straight at fleet utilization and what they're commanding for day rates. Adjusted EBITDA hit $144 million.
That is a significant jump from $97 million in Q1.
Huge jump. And those adjusted EBITDA margins expanded to 32.1%. Or actually 33.5% if you strip out the reimbursables.
And we should probably mention why stripping out reimbursables is important here.
Right, yeah. Basically, when a client asks Seadrill to procure specific fuel or specialized supplies, Seadrill just bills them back.
So it inflates the top-line revenue?
Exactly, but there is virtually no profit margin on it. So that 33.5% adjusted margin is your real signal of the core business efficiency.
That makes sense. And the economic utilization across their premium fleet was incredibly high this quarter, reaching 95.5%, basically 96% if we round up.
Which is incredible. Plus, the average contractual day rates improved to $360,000.
Wow.
Yeah. To put specific steel behind those numbers, you had the West Jupiter and West Capella rigs contributing full quarters of revenue.
Those are the ones that started their new programs in Brazil and Malaysia back in late March, right?
Spot on. You also had the 7 Louisiana and other U.S. Gulf activities supporting that top-line revenue growth.
Okay, so lots of active revenue-generating time.
Yes, and all of that effectively offset the fewer operating days for the West Tellus.
Right, the West Tellus. That rig was essentially out of commission, undergoing reacceptance testing before it started its new Brazil contract late in Q2.
Yeah, and we should talk about that for a second.
Let's actually pause on that, yeah. Because reacceptance testing sounds like, I don't know, a guy with a clipboard checking a few boxes.
Right, like passing a vehicle inspection.
Exactly. But in offshore drilling, it is a massive undertaking. We are talking about bringing a 60,000-ton floating city into a calm anchorage, tearing down its blowout preventers for deep inspection, recalibrating the subsea drilling packages.
And undergoing rigorous safety audits by the new client.
Right. That physical mechanic takes weeks, and it eats up valuable operating days where the rig is earning zero revenue.
Zero. That downtime is a major drag on quarterly earnings, which is exactly why seeing a 96% economic utilization rate across the rest of the fleet is so impressive.
It means the rigs that were actively working operated flawlessly.
Essentially, yeah,
Wow.
with almost zero unexpected mechanical downtime.
Okay, here is where I have to push back a bit, though. 96% economic utilization is virtually maxed out.
Right.
I mean, you can't run a complex piece of offshore machinery at 100% indefinitely without breaking something.
No, of course not.
Pumps fail, pipes corrode, storms force shutdowns.
Yep.
So if utilization is essentially hitting the physical ceiling, doesn't that mean future growth relies entirely on day rate expansion rather than putting more rigs to work?
That is the defining dynamic of the offshore market right now.
Really?
Yeah. When your fleet is fully contracted and operating near maximum efficiency, your lever for top-line growth shifts almost entirely to pricing power.
So it's less about volume and more about price.
Exactly. The growth strategy transitions from finding work for idle rigs to rolling legacy contracts onto leading-edge day rates.
Oh,
You
right.
have rigs that were signed to contracts 2 or 3 years ago when day rates were maybe in the $200,000 to $250,000 range.
Right.
As those contracts roll off, they are repricing into a market where leading-edge rates are pushing $400,000 or higher.
Oh, wow. So almost double in some cases.
Right. So even without adding a single new rig to the water, the revenue and EBITDA can expand purely through that repricing mechanism.
That makes perfect sense. It's like owning an apartment building that is 100% occupied.
That's a great analogy.
The only way you make more money next year is when the old leases expire and you adjust the rent to the current higher market rate.
Exactly. But maxing out your current rigs is only half the battle. If day rates are peaking, the only way to guarantee this isn't a one-quarter fluke is to lock customers into long-term contracts today.
Which brings us to the backlog,
Hmm.
because backlog is basically the oxygen of the offshore drilling sector.
It absolutely is. It's the real leading indicator here. Seadrill's total contract backlog now sits at $2.93 billion.
Up from $2.38 billion at year-end 2025.
Yep. They added roughly $200 million in new awards and extensions in the U.S., Gulf, and Malaysia just since their May update.
Including a one-year U.S. Gulf contract for the West Vela.
Right. And that backlog growth acts as a massive financial moat.
How so?
Well, in a highly cyclical industry, backlog equals visibility. It tells investors exactly what the baseline cash flow will look like for the next several years.
Right. It takes the guesswork out.
More importantly, it serves as collateral. When lenders see ironclad, multi-year contracts from major oil producers, they're far more willing to offer favorable terms on debt.
Because they can literally see the guaranteed future invoices that will cover the interest payments.
Exactly.
You know, CEO Samir Ali noted a tightening deepwater market, and he is predicting that drillship utilization could reach the mid-90% range globally by 2027.
Assuming current tenders actually become awards, yeah?
Right. When I read that, my first thought was that he's drawing a very bold line in the sand for 3 years out.
It is bold. But if you look at the structural constraints on building new ships, it actually makes mathematical sense.
Because nobody is rushing out to build new deepwater rigs right now. The macroeconomics just don't support it.
They really don't. The shipyards in South Korea and Singapore that built these fleets in the 2010s either went bankrupt, pivoted to building highly profitable LNG carriers, or, simply lost the specialized workforce.
Plus, a new drill ship costs upwards of $1 billion and takes 3 to 4 years to build.
Right, so the existing global fleet is essentially capped. Because of those massive capital costs and lead times, new supply cannot suddenly flood the market to crush day rates.
So if the current demand from major oil companies for offshore exploration simply holds steady,
The math dictates that global utilization stays highly compressed.
and when utilization stays above 90% across the entire industry, the drilling contractors hold all the pricing power in negotiations.
Yes, they can dictate not just the day rate, but the contract terms, like demanding that the oil companies cover more of the upfront mobilization costs.
Okay, so that covers the top line and the pricing power, but let's talk about the actual cash.
Let's do it.
Because CFO Grant Creed signaled that Seadrill is entering a period of stronger free cash flow in the second half of 2026.
Yeah, he specifically pointed to major project spending winding down and those newly priced contracts finally kicking in.
That feels like the crucial pivot point for the company's financial narrative.
It really is. Getting a rig ready for a new contract requires massive upfront capital. We discussed reacceptance testing earlier, but there is also mobilization.
Right, like moving a rig from the Gulf of Mexico to a field off the coast of Brazil, that takes weeks.
And you are burning massive amounts of fuel, paying a highly skilled crew, but you aren't drilling a single foot of rock.
Zero revenue.
Exactly. Seadrill has been absorbing those heavy cash outflows in the first half of the year. But with those rigs now actively working and earning those higher day rates, the cash flow profile flips from negative to positive.
And there's very specific catalysts coming up, isn't there?
Yeah, a $40 million mobilization fee from Petrobras expected in Q3 for the West Tellus.
Because when an operator like Petrobras requires a rig to move across the globe or, undergo specific modifications for their field, they pay a mobilization fee to offset those costs.
Right, and that cash often arrives in a lump sum.
So that $40 million injection alone will be a massive tailwind for third quarter free cash flow.
providing tangible evidence of Creed's promise that the second half of the year will look materially different.
If you are tracking the cash flow outlook, you also have to look closely at how management is actually allocating that capital, right?
Yeah, you have to look at how they are engineering the balance sheet.
Because they successfully refinanced their debt this quarter. They issued $700 million of 6.75% senior notes due in 2034 and redeemed their 2030 notes.
They also upsized their revolving credit facility from $225 million to $300 million and extended its maturity out to 2031.
Okay, so they finished the quarter with $360 million in cash and equivalents against $750 million in gross principal debt.
Which leaves them with a net debt of $390 million. That is a highly manageable leverage profile for a company generating this level of EBITDA.
Okay, wait, I'm looking at the income statement and I have to challenge this debt move. Seadrill took a $35 million extinguishment loss just to push their debt maturities out from 2030 to 2034.
Yes, they did.
When you see a $35 million hit on an income statement, your instinct is probably to panic. Why take a $35 million accounting hit now when the original debt wasn't due for another 4 years?
I get it. It seems like an unforced error.
It seems like it destroys quarterly net income for no immediate reason.
It looks painful on the income statement today, but you actually want management to do this.
Really? Why?
In cyclical industries like offshore drilling, you refinance when the credit markets are open and favorable to you, not when you are forced to with your back against the wall.
Ah, okay.
That $35 million extinguishment loss is essentially an early termination penalty paid to the bondholders. But by taking that hit now, they have cleared their debt runway for the next decade.
So there is no looming maturity wall to spook equity investors or lenders if the oil market hits a soft patch in 2028.
Exactly. And beyond that, refinancing allows them to re-rate their debt covenants.
Debt covenants being the strict rules that lenders place on a company to restrict what they can do with their cash.
Correct. Old debt agreements might have blocked stock buybacks or dividend payments if the company's leverage ticked up even slightly.
Oh, I see.
The new debt clears the way for those shareholder returns. It guarantees their operational flexibility, which is the entire reason they can aggressively pursue their buyback program.
Which brings us directly to those shareholder returns. Seadrill bought back 511,078 shares for about $20 million during the quarter.
At an average price of $38.66, yeah.
And they've extended their $500 million share repurchase program through the end of 2026, with $188 million in capacity still remaining.
Buying back shares at an average of $38.66 is highly accretive when you consider the stock is currently trading in the upper 40s.
Because it mathematically increases the fundamental value of all the remaining shares.
Right, because the company's future profits are divided among fewer total shares. It shows disciplined execution by management. They aren't just blindly buying at the market, they are taking advantage of dips.
We also have to talk about who actually owns those remaining shares.
Yeah.
Because institutional ownership is massive here.
It's the elephant in the room. 95.67% of shares are held by institutions like BlackRock, Elliott Investment Management, and Vanguard.
Almost 96%.
Yeah. That institutional concentration fundamentally alters how the stock trades because it heavily restricts the float.
The float being the actual number of shares available to trade by the public on the open market.
Yes. When over 95% of the company is locked up by major funds, the tradable supply of shares is incredibly thin.
So that means when positive news hits, like this massive EPS beat, the stock can gap up violently because there just isn't enough supply to meet the sudden retail or algorithmic demand.
Exactly. Conversely, it means management is under intense, sophisticated scrutiny. Funds like Elliott Investment Management do not hold passive, quiet stakes.
Right, they are activist investors.
Activist investors who demand ruthlessly efficient capital allocation, which is precisely why you are seeing aggressive balance sheet management and committed buybacks. The whales are dictating the strategy.
Okay, that sets up the bullish narrative nicely. But if we are doing a real deep dive, we have to look at the underlying risks and the bear case.
Always.
Because despite that massive gap up in pre-market, the stock actually flatlined later in the week instead of continuing its breakout. If everything is so great, why did the rally stall?
It comes down to the cash.
Right. Despite the massive 47-cent EPS beat, Q2 free cash flow was actually negative $43 million.
Driven by net cash used in operations of negative $18 million and $25 million in capex.
That is the exact friction point for analysts right now.
It is. The trailing 12-month net income has plummeted to just $1 million, compared to $460 million in the year-ago period.
Wow, from 460 million down to 1 million.
Yeah, and some analysts are still flagging negative net margins, specifically negative 4.79%, and a negative return on equity over the trailing periods.
Basically warning that the financial turnaround is incomplete and that earnings driven by lumpy, multi-year contracts can be highly volatile.
Right. The stock still carries a moderate buy average rating with a $55 target, though BWS Financial maintains an aggressive $80 target.
But wait, how do we square a 47-cent EPS beat with negative $43 million in free cash flow?
It can seem contradictory.
It's like a massive manufacturing company buying hundreds of millions of dollars in raw steel in April to fulfill a guaranteed mega order in August. If you take a snapshot of their bank account in June, they look completely broke. But the contract is already signed and the profit is locked in.
That's a great way to look at it.
But are retail investors just cheering for accounting profits while completely ignoring the actual cash burn?
Well, it goes back to the mechanics of working capital and rig mobilizations. GAAP earnings recognize revenue when the service is performed, and it smooths out the capital expenditures through depreciation over a long period.
But cash flow is brutal and immediate.
Exactly. In Q2, Seadrill was paying real, immediate cash out the door for payroll, shipyard upgrades, and mobilization fuel for rigs like the West Tellus.
The revenue for that prep work might be recognized on the income statement, but the bulk cash payments from the client don't arrive until the rig is actually drilling.
So the cash outflow happens in quarter A, but the cash inflow happens in quarter B, creating this optical illusion of a cash burn.
Got it.
So a negative free cash flow quarter in this specific context isn't necessarily a sign of distress. It is the prerequisite investment required to unlock the high-margin cash flow in the following quarters.
However, the bear case is completely valid to point out the trailing 12-month net income drop to $1 million.
Oh, absolutely. That massive drop from $460 million a year ago reminds us how volatile this business really is.
One contract termination, one major shipyard delay, and a profitable year can instantly evaporate.
Which is exactly why analysts are flashing warning signs about those negative net margins and negative return on equity over the trailing periods.
An incomplete turnaround means the margin of error is razor thin.
Yep. If global oil demand softens and operators delay their deepwater final investment decisions, that 2027 mid-90% utilization forecast from the CEO turns into a pipe dream.
And day rates will crash back down just as quickly as they rose.
The market is demanding tangible proof. Sophisticated investors saw the EPS beat, they applauded the raised guidance, but they are holding back their next wave of buying.
Until they actually see that promised second-half free cash flow physically hit the balance sheet.
Exactly. They want the cash in the bank before they commit more capital to drive the stock past its 52-week high.
So with institutional ownership sitting at almost 96%, retail investors are essentially swimming with whales.
You are playing in a highly concentrated, tightly controlled pool.
But if the deepwater thesis plays out exactly as management predicts into 2027, with constrained rig supply and structurally higher day rates, that remaining $188 million in authorized share buybacks could provide an incredibly hard floor for the stock price.
Because the company will systematically step in and buy every dip.
Right.
But, and this is the crucial caveat, that floor only exists if that promised second-half free cash flow actually materializes to fund those buybacks. Without the cash, the buyback is just a piece of paper, and the floor disappears.
Here's a final thought for you to mull over. We've talked all about Seadrill's pricing power today and their ability to command $400,000 day rates. But remember, the ultimate customer paying those massive invoices is big oil.
Right.
If renewable energy transition mandates accelerate faster than expected globally between now and 2027, will those oil majors still be willing to sign 3-year deepwater contracts at $500,000 a day?
Or will they start reining in offshore exploration budgets entirely?
Exactly. Keep an eye on global energy policy, because that will be the ultimate ceiling on Seadrill's growth. Follow this show for daily earnings coverage.